Oil just spiked after the U.S. struck Iran and the Strait of Hormuz closed. What federal employees need to know about their TSP right now. This is not a drill. Earlier today, Saturday, February 28, 2026, the United States and Israel launched major military strikes against Iran, and Iran responded by doing something it has threatened for decades but never fully executed. It moved to close the Strait of Hormuz. The IRGC, Iran's Revolutionary Guard, broadcast warnings over marine radio, telling vessels not to pass through the strait. Multiple oil companies and trading firms have already paused shipments. Some tankers are diverting entirely. Oil markets don't open until Sunday evening, but analysts are already forecasting Brent crude could jump to $80, $90, even above $100 a barrel when trading begins. And I want to talk to you, specifically federal employees, about what this means. Because a lot of people are going to see scary headlines this weekend and make emotional decisions with their TSP. We are not doing that here. What we are going to do is this. We are going to understand exactly what happened. We are going to understand how markets typically react to this type of event. We are going to break down what this means for every TSP fund, C, S, I, F, and G. And then we are going to build a 3-scenario model so you know exactly what to watch for and how to respond calmly, strategically, not emotionally. So let's get into it. So what actually happened? Let me give you the full picture because the context matters enormously for how you think about your TSP. For the past several weeks, tension between the United States and Iran had been escalating. The Trump administration had been signaling potential military action. Iran responded by conducting live-fire naval drills directly inside the Strait of Hormuz in mid-February, a pointed, deliberate warning. Then today, the U.S. and Israel struck major combat operations, targets in Tehran and across Iran. The Trump administration confirmed it. Iranian state media confirmed it. Smoke rising over the Iranian capital. Within hours, Iran's Islamic Revolutionary Guard Corps began broadcasting on marine radio frequencies, instructing vessels not to transit the Strait of Hormuz. Now, Iran has not formally confirmed a legal closure. The UK Maritime Trade Operations Office has noted it is not legally binding under international law. But here's the thing about markets. Markets don't wait for legal confirmation. They price in risk immediately. And the risk here is enormous because of what the Strait of Hormuz actually is. The strait sits between Iran to the north and Oman and the UAE to the south. It is roughly 33 kilometers wide at its narrowest point, a sliver of ocean that connects the entire Persian Gulf to the open sea. Now here's the number I need you to hold in your mind, 20%. About 20% of the world's total daily oil consumption flows through that corridor. That's roughly 20 million barrels of oil per day. Saudi Arabia, Iraq, UAE, Kuwait, Qatar, their exports go through that waterway. And it's not just oil. About 20% of global liquefied natural gas exports, almost all of it from Qatar, flows through the same passage. There is no pipeline alternative for LNG. It must move by ship through the strait. Iran understands its geographic leverage. Its parliament actually passed a motion last year to authorize closing the strait. Under international law, the shipping lanes at the narrowest point fall within the territorial waters of Iran and Oman. Tehran can physically threaten traffic with mines, fast attack boats, anti-ship missiles, and submarines. Former White House energy advisor Bob McNally put it plainly today. This is the real deal. And energy analysts at Barclays told Reuters oil markets might have to face their worst fears on Monday. So, that is what is happening. That is the actual event. Now let's talk about what this typically means for markets, and specifically for your TSP. So how do markets react to an oil shock? Let me walk you through the classic sequence of events when oil prices spike suddenly due to geopolitical disruption. Because understanding the chain reaction is how you understand what happens to your retirement accounts. Step 1. Oil spikes. When a credible threat to supply emerges, oil prices move instantly and dramatically. We're looking at a baseline of around $70 to $73 per barrel for Brent crude right now. Analysts are forecasting a jump of $5 to $10 when markets open Sunday evening, and potentially above $100 if a real sustained disruption materializes. Why does oil move so fast? Because oil is the lifeblood of the global economy. It's embedded in everything: transportation, manufacturing, agriculture, plastics, utilities, shipping. When supply risk appears, every buyer in the world scrambles. Step 2. Energy stocks rally. Higher oil prices are a windfall for energy producers. Exxon, Chevron, ConocoPhillips, energy ETFs. These names move up sharply when oil spikes. This is actually a partial cushion for the C fund because energy is a component of the S&P 500. But, and this is critical, energy's weight in the S&P is not dominant enough to protect the broader index if the shock is large enough. Step 3. Airlines and transportation get hit. Fuel is one of the single largest operating costs for airlines and shipping companies. When oil spikes, their profit margins compress immediately. You typically see airlines, logistics companies, and manufacturers with large transportation costs sell off sharply. Step 4. Broad markets wobble. Here's where it gets important for your TSP. If oil spikes hard enough, it does two things simultaneously. It raises inflation expectations, and it raises recession fears. Those two things pull markets in different directions. Higher inflation means higher costs for everyone. Higher costs mean lower corporate earnings. Lower earnings mean lower stock prices. But it's more complicated than that, because higher oil can also slow economic activity enough that investors start pricing in a recession, demand destruction, and that shifts the entire narrative. And step 5, the risk-off rotation. When fear enters markets, investors rotate into what they call safe haven assets. Gold typically rises. We're already seeing this signal. The US dollar often strengthens as investors seek safety. Japanese yen strengthens, another classic flight to safety trade. US Treasury yields either rise because of inflation fears or fall because of recession fears. Which one dominates depends on the severity and duration of the shock. Today, CNBC's market watchers are already calling for a risk-off Monday open. Global equities potentially down 1 to 2% or more at the open. Now, let's bring all of this directly home to your TSP. Let's discuss fund-by-fund breakdown. Let's go through every TSP fund one by one. What is it exposed to? How does it react to an oil shock? And what does it mean for you? C Fund, or the Common Stock Index Investment Fund. The C Fund tracks the S&P 500. It's your primary large-cap U.S. equity exposure. In a geopolitical oil shock, the C Fund faces two cross-currents. On the positive side, energy companies, Exxon, Chevron, and the broader energy sector represent a component of the S&P 500, and they rally when oil spikes. That gives the index some natural buffer. On the negative side, if oil rises sharply enough to stoke inflation fears or recession fears, the broader index can still decline significantly. The energy buffer is real, but it doesn't fully protect you from a major market sell-off. History is instructive here. In June 2025, when Israel struck Iranian nuclear sites, the S&P 500 sold off sharply at the open, then recovered once it became clear the strait had not been disrupted. That is the template markets are working from right now. Bottom line on C Fund, expect volatility. A 1 to 5% dip is plausible Monday. The severity of any move and whether it sticks depends entirely on whether the strait disruption is real and sustained. SFUND, or the Small Cap Stock Index Investment Fund. The S Fund tracks smaller U.S. companies. And here's the thing about small caps in an oil shock. They are more vulnerable, not less. Small companies tend to have thinner margins, less pricing power, and less ability to absorb rising input costs. If oil stays elevated for months, small caps feel it harder. Small caps also tend to be more sensitive to domestic economic conditions. If higher oil triggers a broader economic slowdown, which is a real risk in scenario C, which we'll cover in a moment, the S Fund typically swings more aggressively than the C Fund. Higher beta, more volatility. That's the S Fund in a geopolitical shock. I Fund, or the International Stock Index Investment Fund. The I Fund tracks international developed markets, primarily Europe and parts of Asia. And this is where the oil shock cuts deepest. Why? Because Europe and Asia are significantly more energy import dependent than the United States. The US has become a major oil producer. European nations have not. They import heavily from the Middle East. If oil spikes to $100 and stays there, European manufacturing costs rise, European airline costs rise, European consumer spending tightens. The economic hit to European markets is proportionally larger than the hit to U.S. markets. Currency dynamics compound this. In a risk-off environment, the U.S. dollar tends to strengthen. A stronger dollar, from the perspective of a U.S. investor holding international stocks, actually reduces your returns further because the foreign currency denominated gains get converted back at an unfavorable rate. Additionally, the I Fund is not well insulated from what's happening in the Middle East right now. The Bab al-Mandab Strait at the entrance to the Red Sea is also at risk given Houthi activity. Shipping through both choke points could be disrupted simultaneously. Bottom line on iFund: in a sustained oil shock, the iFund is your most exposed equity fund. Watch it carefully. F Fund, or the Fixed Income Index Investment Fund. The F Fund tracks bonds, specifically a broad U.S. investment-grade bond index, and its reaction to an oil shock is genuinely nuanced. It depends on which fear wins. If oil spikes and investors primarily fear inflation, that is, if they believe the oil shock will push prices higher across the economy, bond yields will rise. When yields rise, bond prices fall. That hurts the F Fund. But if oil spikes and investors primarily fear recession, that is, if they believe the oil shock will slow economic activity and demand, yields can actually fall as investors flee to the safety of treasuries. When yields fall, bond prices rise. That helps the F Fund. Right now, in the early hours after the strikes, the initial read from analysts is a risk-off move, flight to safety. That narrative, if it holds, would tend to benefit the F Fund. But if Monday opens with rising inflation expectations dominating the narrative, the F Fund could face headwinds instead. Watch which story markets are telling: inflation fear or recession fear. That tells you where the F Fund goes. And finally, the G Fund, or the Government Securities Investment Fund. The G Fund is the psychological safe haven of the TSP system. It holds U.S. government securities. It has zero market volatility. It earns a steady government rate return. Your balance does not go down. And every time there is a geopolitical shock, I see federal employees flooding IFTs into the G Fund, and I understand the impulse. But here is the behavioral trap I need you to understand. Most geopolitical oil shocks are temporary. When Israel struck Iranian nuclear sites in June 2025, the market sold off at the open and recovered the same day, once the Strait stayed open. Investors who moved to G locked in losses and then missed the recovery. The G Fund is not inherently bad. It is appropriate as a ballast, a stabilizing portion of your allocation if you are near retirement or already in a defensive posture. It is appropriate in Scenario C, which I will describe in a moment. But moving your entire TSP to G because of a scary weekend headline, that is a decision made by fear, not strategy. And fear-based decisions in retirement accounts are how federal employees give away years of compounding. Don't let that be you. Okay, now let's build the scenario model. Here is the 3-scenario model. This is the section that separates strategic thinking from reactive thinking. We are going to model 3 distinct scenarios based on how this situation unfolds, because your response should depend on which scenario you're actually in. Scenario A, temporary escalation, the headline fades. In Scenario A, the US-Iran conflict is sharp but short. Strikes happen. Iran makes noise. The Strait is threatened. Oil spikes initially, maybe to $80 or $85, but within 1 to 2 weeks, either a diplomatic signal emerges, the U.S. Navy escorts tankers through successfully, or Iran backs down from a full closure because the economic pain to itself is too severe. This is actually what happened in June 2025. Spike, scare, recover. Markets dip 3 to 5% in the first week, then they recover, possibly within days. What do you do in Scenario A? Nothing emotional. You hold your allocation. If you have a regular contribution coming in, it buys at a slightly lower price. That's a feature, not a bug. If you are disciplined and have a rebalancing plan, you rebalance to your target allocation. That's it. You do not touch your IFTs. You do not move to G. You stay the course. This is the most historically likely scenario. Markets have absorbed geopolitical shocks at the Strait of Hormuz before: 1988, 2012, 2019, 2025. Every time the Strait stayed open, every time markets recovered. Scenario B, prolonged tension, the slow burn. In Scenario B, the conflict does not resolve quickly. Maybe the U.S. commits to a longer-term military campaign. Maybe Iran conducts ongoing harassment of tanker traffic without a full closure. Maybe oil stays elevated $100 to $115 per barrel for 3 to 6 months. This is a more challenging environment for your TSP. Elevated oil for months means inflation expectations stay higher for longer. The Federal Reserve, which was expected to cut interest rates this year, may now pause those cuts. Markets reprice. Fixed income gets complicated. Equities move sideways or experience rolling corrections. The U.S. consumer feels it at the gas pump and in grocery prices. Corporate margins get squeezed across industries. Small caps feel it more than large caps. International markets feel it more than domestic. What do you do in Scenario B? You stay disciplined. You resist emotional IFTs. You continue contributions because you are buying through a period of elevated volatility, which historically has been rewarded over long time horizons. If you are already overexposed to the S fund or I fund relative to your long-term target, This might be a moment to rebalance toward your target, not flee entirely, but calibrate. You may want to reduce your tilt toward small caps and international if you are significantly overweight, but you are not abandoning your strategy. You are not moving everything to G, because in scenario B, the recovery will come. It will just take longer than scenario A. Remember, you are not a day trader. You are a federal employee building a pension plus TSP plus brokerage system over decades. A 6-month chop doesn't derail that system unless you let it. Scenario C, sustained disruption, the real crisis. Scenario C is the low probability, high impact tail risk. This is a genuine, sustained closure of the Strait of Hormuz, weeks or months of real supply disruption. If this happens, oil goes above $120. Energy analysts today use the word guaranteed global recession to describe a prolonged closure. Asian nations begin hoarding energy reserves, global manufacturing slows, shipping costs spike, inflation surges even as economic growth contracts, the dreaded stagflation scenario. Equity markets would face a significant correction. The C fund, S fund, and I fund would all face meaningful downside. The I fund would likely face the most pressure given European and Asian energy dependence. What do you do in scenario C? This is where a defensive posture, now not after the damage is done, actually makes sense. A meaningful allocation to the G fund as ballast. A look at the F fund, but only if recession fear is dominating inflation fear in the market narrative, because that's when bonds actually benefit from the shock. But here is the critical word in scenario C. Early. The time to make a defensive move in a true crisis scenario is before the full disruption is confirmed, not after markets have already priced it in. Moving to G after a 15% drop locks in the loss and misses the rebound, and scenario C requires sustained disruption, not headlines, not radio broadcasts, not threatening gestures, actual confirmed ongoing closure of the strait that is preventing tanker traffic over weeks, not hours. We are not there yet. As of this recording, it is unclear whether Iran's closure is real or performative. Watch the tanker traffic. Watch whether the U.S. Navy escort ships through. Watch whether oil prices are still rising or starting to stabilize Monday afternoon. Those are your signals. So, what should federal employees actually do? Okay, let me be straight with you. I don't know exactly how this plays out. Nobody does. Not the analysts at Barclays, not the strategists at Goldman, not the former White House energy advisors who are warning about a worst-case scenario. What I do know is this. You are not in a position to out-trade oil markets. You have 2 IFTs per month in your TSP. The institutions moving billions of dollars in the first milliseconds of Monday morning's open are not going to be beaten by a retail allocation shift. That's not the game you're playing. The game you're playing is different, and it's actually the better game. You have a pension. That pension is a bond-like asset. It is inflation adjusted. It pays for life. It does not go to zero because oil spiked. Your TSP is your growth engine. It is exposed to markets. Yes, it will fluctuate, yes. But it is also invested across decades, not days. If you are 35 years old and markets drop 10% because of an oil shock that resolves, in 3 weeks, you just got a discount on the next 12 months of contributions. That is not catastrophe. That is opportunity. If you are 55 and approaching retirement, your risk profile should already have shifted toward a more defensive posture. Not because of this event, but because that's what sound TSP management looks like as you near your separation date. Here is what I want you to actually do this weekend. First, do not make a TSP change while you are anxious. Wait, watch Monday's market open. See how the narrative develops. Is the strait actually closed? Is tanker traffic moving or not? That tells you which scenario you're in. Second, know your scenario triggers. If oil stabilizes below $90 by Wednesday, scenario A, stay put. If oil is still at $105 by end of next week, you're trending towards scenario B. Calibrate thoughtfully, not emotionally. If oil is above $115 and tanker traffic is genuinely disrupted, now you're in scenario C territory, and a defensive tilt is warranted. Third, keep contributing. Whatever you do with your allocation, do not stop your contributions. Stopping contributions in a down market is the single worst thing you can do to your long-term retirement trajectory. Every contribution you make in a down market buys more shares at lower prices. That compounds for decades. Fourth, zoom out. Your TSP is not a brokerage account you check every hour. It is a long-duration wealth accumulation vehicle sitting alongside a federal pension that most private sector workers would give anything to have. One weekend of geopolitical shock does not define your retirement. Stay the course, watch the signals, Use the framework. Here is what we covered today. The United States and Israel struck Iran. Iran responded by claiming to close the Strait of Hormuz, a waterway through which 20% of global oil flows. Markets have not opened yet. Analysts expect an oil spike to $80 or beyond. When they do, a worst-case scenario puts Brent crude above $100. For your TSP, the C fund will face short-term volatility, but has some energy sector cushion. The S fund will be more volatile. The I fund faces the most exposure given European and Asian energy dependence. The F fund depends on whether inflation fear or recession fear wins the narrative. The G fund is your ballast, not your escape hatch. You are in one of three scenarios: temporary spike and recovery, prolonged tension and chop, or a genuine sustained supply disruption that warrants defensive positioning. The signals to watch are oil price trajectory, tanker traffic through the strait, and whether the U.S. Navy successfully escorts ships through in the coming days. Don't act on fear. Act on data. Act on framework. If you want to go deeper, I'm building scenario stress testing tools inside FireFed, tools that let you model your specific TSP balance under an oil at 120 environment, a prolonged inflation scenario, and various market drawdown depths. The link is below. Hit subscribe if you want to stay ahead of the next event like this one, because in a world where the US is conducting major combat operations in Iran, this is not the last time you'll need a framework like this. Stay calm. Stay strategic. I'll see you in the next one.